And let's kind of see what we're doing here as far as interest rates go. And we all know that inflation is the #1 factor in determining what mortgage rates do. And this is a really good chart kind of showing in the last couple of years where inflation has gone on the PCE. So we were up pretty high in the sixes, close to 7. And you can see over this last year, the inflation numbers, and this is a 3-month, 6-month, or year over year, have really come down. And that's why we know mortgage rates are going to come down. Now, they haven't come down dramatically, but I mean, they were in the 8s and now they're in the 6s and 7s. So we have come down a lot, and I think that's pulled a few people off the fence. But really, the unemployment numbers and the recessionary aspects of the market are really going to continue to bring the rates down. And the next chart I'm going to have is going to be really interesting. We all see the employment numbers, and we see these big employment numbers, but it doesn't categorize whether it's multiple. Hold on, I think I've got some people trying to jump on one second here. Yep, there we go. Whether it's people with multiple jobs or it's just people that hold a single job. So check this out. This is how many people that need second jobs have now just gone into our market, into the economy. Look at that jump. We went from people not needing a second job at all to over, I mean, we have almost 2 million more people with second jobs trying to get through just because of inflation. The cost of living is higher. It's just been, so when you see employment numbers going up, a lot of those are second jobs. Whereas before it wasn't really needed. So we're above where we were pre-pandemic, which is a good indication of kind of where we're going. We continue to rise there. So I thought that was a really interesting chart. And then as we're moving in, I told you guys I had some predictions, but I didn't really lay it out as far as when the rates were going to get where they were and the timeline of when they're going to hit the 5s. It could be sooner than this, but because of the bond market and the amount of treasuries that are coming to the market, because of the amount of selling of bonds that's going to slow down, I think the interest rate drop. I've kind of gotten a little conservative. So looking back at Fannie Mae's, I think they've got the best projection of where rates are going to be. And here we are, guys. Here's the rate projections for next year. Boom. Here we are. So if your customers are wondering, well, Sean, or where rates going to be? When can I think about refinancing? Well, this is where I believe rates were going to be. So right now, we're in Q1. So 7%, Q2, we're going to look at more of a 6.8. Q3, 6.6, Q4, 6.5. See the slowly drawing down of the rates. I think it's going to be in, I think Q4 is where we're going to see rates in the 5s. That's my prediction. And this is kind of like the month over month where we're going to see. Now, January, I don't know how low we're going to go in January. We got a lot of bond auctions happening this week, and a lot of the economic data from December, which is typically really hot because that's what the holiday season, right? That's where people spend a lot of money. That may have skewed results on here, but Q4 2024 is where I think we're going to hit that 5.8, guys. So I think it's going to be exciting to have that. And we just need to make sure our buyers understand that once we hit that 5.8, it's going to be crazy. I mean, low 6s is going to be crazy, but 5s is going to be, I think, a little bit wild because our inventory still is pretty low. Let's hopefully we'll get some people off the fence that had really low rates that they didn't want to get rid of, but when they see rates coming down, they'll be more apt to sell their home to get the next, maybe upgrade their home or downsize. So let's go see what rates are doing today. Let's have a look at our charts. And if this will go, there we go. So these are the mortgage-backed securities this last couple of weeks. So back in December, we saw the mortgage bonds hit the peak. We really got to the best rates were on December 28th of last year. We got a little bit worse, gained a little ground, and continued to get worse. And now we're just above this 50-day moving average, and we've bounced off of it, and we're going back towards the 25-day moving average. We touched it this morning. We bounced off it. We're we're in between this range. So we're kind of flat, but we have a very, very big week this week. We'll go over that in just a minute to kind of show what's going to be happening. But hopefully we can break through this 25-day moving average and go back up and keep rising on the mortgage-backed securities bonds so that we can see some better rates. So we're positive today. That's a good thing. Let's hope that continues. But look at the 10-year, guys. This is magic how this happens. So last week, the 10-year rose, and when the 10-year rises, so do interest rates. So when this went up, we just stopped right on that 50-day moving average, and then we kept right in the middle here the next day, and the next day, and the next day. We're just stuck on this 50-day moving average. Let's hope that continues to hold. Today, we're below it. So that's a good sign. That means this level of resistance is keeping rates low. That's a really, really good sign. We're going to watch that carefully. So we're floating rates right now. But you want to say, well, where are rates right now? Well, here's a good indication of what we are. If you are perfect, if you are 30% down on a conventional loan with an 800 score, you're in the sixes. So congratulations. You could buy it down a little bit, and it doesn't take much to buy it down to get into the mid sixes, and I'll go over that in just a second. But with an 800 score, 30% down, this is where you are. Not bad. So, I mean, it was in the eights, right? So we're in the sixes. This is if you're perfect, but I want you to see the difference in the loan level adjustments on interest rates, because this person with an 800 credit score, well, let's just say they had a 710 credit score. The same and only 20% down. Still pretty good, 20% down, right? But just because of the credit score, they're more than a half higher in rate. So when people come to me and they say, Sean, what's your rate? Really, we need to know your credit score. And those handheld, the credit scores you get on your bank apps, they're terrible. They're about 20 points off for the most part. It's not the same algorithm to calculate a credit score. So usually people are disappointed when they get their mortgage credit rating because they see those on their, apps that they have from all their different credit cards. But that's a pretty big difference. So you're in the sixes and sevens right now in rates. If somebody says, what's the rate today? And they say sixes, yes, if you're perfect. But we all know nobody's perfect. So what's happening this week? Let's jump into that right now because it's going to be a really active week. One of the biggest things we're going to be watching is the announcement of how much treasuries are going to be entered into the bond market this week. That'll be an interesting number because hopefully they're going to start slowing their roll, so to speak, on that, because the more bonds they have to sell, the more debt we have to sell. That's inflationary. That's bad. So we want to keep an eye on that. But we have our job openings coming out tomorrow to see how many new openings there are in the jobs world. This is a big jobs week. We've got payroll, private payroll through ADP on Wednesday. And then the good old Fed is going to be talking on Wednesday afternoon and doing their interest rate decision. We all know that they say that they're not going to be raising rates. We don't know when they're going to be cutting, but they were very dovish. Now, what dovish means, and this was last month, they were very dovish, meaning that they think rates were going to come down. They're going to start cutting soon. Very positive for rate cuts. That's dovish. Hawkish is where they're coming out with verbiage like, we don't know, the market's still too hot. We think we may hold the interest rates here longer and slow down the cutting for maybe further down the road. That's hawkish. They think rates are going to stay higher. Dovish is more thinking rates are coming down lower. So we'll see what kind of a pulse Mr. Powell has this Wednesday. It's going to be really interesting to see. That'll be the decision on whether they're going to cut rates maybe March or maybe May. But we do have jobless claims coming out this Thursday. If we have high jobless numbers, that's really good for mortgage rates. If manufacturing and the ISM manufacturing is coming out on Thursday as well, if the manufacturing is lower, that's good for interest rates. Keep in mind, bad news with the economy is typically really good for interest rates. And then Friday, we have the unemployment rate, non-farm payrolls coming out on Friday. So it's going to be a really big week. Lots of volatility. Let's hope these numbers come in a little low on the hotness of the economy, maybe hopefully showing a little weakness in the economy. That will really help mortgage rates as we push into through this week. So I'm going to stop sharing real fast because I want to get into this real fast. We've talked about buy downs for a long time. And the reason I'm bringing this up, we do have a new, there's somebody here waiting. We do have a new product I'm going to talk about that's for second homes, but I'm going to jump into something that's become really a hot topic, and it's called stacking buy downs. So if you haven't ever heard of this, we all know that there's permanent rate buy downs. You can pay points to get a lower rate. And we all have heard of the seller buy down, which is where you could do a 3-2-1 buy down or a 2-1 buy down. But nobody ever talks about putting the two of them together. So I'm going to discuss that today. So basically what that means is we're going to be permanently buying the rate down, and then we're going to do a 3-2-1 buy down on top of that already low rate that we bought the rate down. So I'm going to share my screen again and show you a little bit about what that looks like, because I think, I'll share with you a personal experience on what this exactly looks like. So stacking buy downs, here we go. I'm looking at a rate sheet right here in the top left corner. This is the cost to buy the rate down to 5.875 highlighted. So I've highlighted that. That's a cost of 2.921 points. Now that's based on the loan amount, 2.9% of the loan amount. Now, when we ask for concessions, we're always asking for concessions based on the percentage of the purchase price. So the cost for the loan is based on the loan amount. When we ask for concessions, it's based on the purchase price. So this 2.921 of the loan amount cost is equal to about 3.5%. I'm sorry, about 2.5% of the sellers from the actual purchase price. So we get a little bit more bang for your buck, but we're going to buy the rate down. Let's just pretend we're going to buy the rate down to 5.875 from where it's at now. We're going to ask sellers to pay for this, or we're going to maybe pay for it ourselves. And then we're going to ask the sellers here to do a 3-2-1 buy down, which are the charts below. Now, this 3-2-1 buy down, we start with the lower rate that we just did the permanent buy down with of 5.875. And then we take 3% off the rate. So the first year, your rate is 2.875. Now, a 3-2-1 buy down just means 3% less the first year, 2% less the second year, 1% less the third year, and then it goes to the permanent rate, which in this case would be 5.875. So the first year, this person's payment is 2.875. That's phenomenal. The second year, it's 3.875, and the fourth year, it's 4.875. Now, you can also, if you're not going to get as much money, because this is kind of expensive, you're going to ask for almost $21,000 from the seller, plus we're doing a permanent buy down. If the property doesn't have the opportunity to get this big amount of money, you can lower that to a 2-1 buy down, which is about $6,000 cheaper, and the first year would be 3.875. So the reason I'm showing this is you're all real estate agents. If you have family members, you can do this. But here's a hack. If you have a child, I have a child, his name's Zane. We just did this for him. Now, my wife is a real estate agent, but she doesn't do business. She just manages our rental properties. But she is helping my son buy a house, and she used her commissions to do the permanent rate buy down, and we asked the seller to do the 3-2-1 buy down. And now my son is in his first house, and his first rate this year is 2.875. So if you have family members that are looking to buy, and you're going to waive your commissions or whatever you want to be, or if you want to ask the sellers to pay for all of this, this is what you can do, because it turned my son into a believer and able to afford this. And now he's going to get roommates. It's fantastic, right? So this is a personal experience, and I don't think I've seen anyone ever do this before. And correct me if I'm wrong, but if you've heard of this before, if you've seen people do this, let me know. But I think I'm the first to ever talk about it. But it's fantastic. Now, you may wonder, how much can the sellers actually give? And this is where it becomes important, because what we can do is ask for as much as we can get, and then we can play with these numbers. We can buy it down a little bit and then do a 2-1 buy down, buy it down a lot and then do a 2-1 buy down. There's a lot we can do with it. We just need to try to get creative with how much we have to use. So here's a chart on how much we can ask for. Now, I posted this to social media last week, and I want to make sure that you guys really grasp this so that we know what kind of loan your borrower has. And you can always ask me, but for a conventional loan on a primary or secondary home, if you do less than 10% down, you can only ask for 3%. If the buyer is putting 10% to 25% down, you can ask for up to 6%. Typically, that'll cover it and everything you need. If it's more than 25%, you can get up to 9%. Now, a seller willing to give that much is rare. It doesn't happen very often, but it could. And then investment properties, you can only get 2%. FHA, you can get up to 6%. VA, you can get up to 4%, but only 2 discount points in that. So you can also include debt. You can have the seller pay off some debt to help them qualify. So that's another cool thing with VA. And then USDA is 6% as well. So keep this. If you guys can do a screenshot and save this, or if you want a copy of it, it's on my social media on Facebook and everywhere. This is a really good chart when you are trying to figure out how much you can ask for, depending on the loan amount. So really, really important. You can always call and ask me, but this is really, really important. Now, I'm going to hop back out of this real fast. Another big question people have, and this is, if any of you have any listings, especially if you have a listing for a VA buyer or VA seller, this is incredibly important to understand. I'm going to help you calculate and teach you how to calculate what your buyers can get if they let somebody assume their VA mortgage. What does that look like if they try to buy another home using VA? Okay, this is very important. If any of you have a listing of a veteran that has a VA mortgage on it, to help you understand and try to help buyers take advantage of an assumable mortgage, because a lot of people think if a non-veteran assumes a mortgage, they lose their eligibility completely, and that's not the case. So I'm going to show you a scenario where a veteran is going to sell a home and let a non-veteran assume that low mortgage rate and what that looks like for them for the next purchase. Okay, so this is going to be, you need to follow me on this. If I can get to the next slide. Okay, let's just assume the veteran is currently has a home for sale and they're selling their home for $585. Okay, their current loan balance is $376,000 on their current loan.
Hey, Sean, we can't see your screen.
Oh, you can't. Thank you so much for letting me know. I forgot to hit the share screen button, guys. I sincerely apologize. Thank you for hopping in. All right, let's do that again here. Oh, I went right back to the beginning. Okay, here we go. All right, so we're at a VA seller. The seller has a $585,000 listing that you are listing. All right, they have a balance of their loan on there right now. It's $376,301. So after commissions, we're going to say they're going to net about $180,000. Okay, let's just say I'm a non-veteran, and I'm going to say I want to buy your house. I want to come in here and I want to buy your house, but I'm not a veteran, so you're going to lose that eligibility. So that original loan balance that they had was the next line, that $390,000. That's their original loan balance. They're going to lose that eligibility, and they're only going to have a remaining balance of their eligibility left. Well, how much is that? That number is calculated by how much their original loan balance was minus the conventional loan limit right now, which is $766,550. So that math shakes out to be $376,550 is left on their eligibility for 100% financing. And you may say to yourself, well, that's not enough. They're trying to find a $750,000 house. How's that going to work? Here's the magic that you need to know, because VA is special. So $376,550 is what they have. The VA, the money remaining, there's $373,000 remaining. Well, they're only netting $180,000, so they can't bridge that gap. However, VA will fund 75% of what's needed still above your actual eligibility. So in this case, VA will come in and they will fund $280,000 of that. So what's left? Only $93,000 is left for that VA person to buy the next home at a $750,000 purchase price. They're netting $180,000 from that sale, which means they're going to have $90,000 in the bank after they buy a new house, or roughly. This is important to know because a lot of you are, a lot of agents, let's get very wide range on this, are afraid of this calculation, or they don't know of this calculation, so they just don't want to accept a non-veteran when they're making an offer on a home on an assumable mortgage. I think this is the most unknown factor in all of the mortgage industry of what this next purchase for a VA, if somebody assumes your loan, looks like. I'm going to clip this short part of this and put this on my website for you guys to see as well, so you can always come back to it. But this calculation is, I think, the most unknown part of the entire mortgage world. If you guys haven't heard this before, I would love to know what your thoughts are on it. But if you ever have a veteran that is looking to use their VA benefits and they have an offer coming in from a non-veteran, you need to know this, and call me if you forget it, but you need to know this because this is a huge part of our market right now with those low rates in the 2s on veterans. So it's, I think, very, very important. So I'm going to stop.
Sean,
yes.
On that, the funds that the VA comes in with 75%, that's a loan, right? I mean,
that is the loan. Yes. So they're
Okay,
going to
so-
increase the loan balance by 75% more.
Okay, so at the same rate as it's one loan now.
That's exactly right. So
Okay.
they're just going to increase the loan amount available by that 75%. So most people think you're capped at that max percent, the 765,000 in total loans and 550, 766, 550. But VA will fund way more than that. In fact, whatever the difference is above that, they will continue to fund and add 75% of that to your loan balance. So fantastic thing to know, because I've seen a lot of people turn down offers because it's a non-veteran, when the veteran could have accepted that and moved on and still bought his house using VA with that upgraded home. So super important if you have a listing that has a VA loan on it. Really, really, really important. Any other questions on that? Fantastic. I must be the best teacher on the planet because there's no questions.
I have a question. That additional loan that the VA is getting on the second home, that is at the present interest rate, right?
Yes. Yep.
Okay, so that could be a huge difference in what we're paying per month. But
that's for the person selling the home. The person assuming that mortgage, I'm not talking about that buyer. I'm talking about the person that's going to be selling their home and moving on to a different one. So this home,
I know, but the different home, they were going to have a larger mortgage than what they had in the previous home.
That is correct. Yeah.
And it's at a higher interest rate.
That is correct. But they're going to be leaving that house anyhow.
Right.
So they may be thinking about a conventional loan or a VA loan anyhow. So they're already knowing they're going to get a higher rate in the next house they're getting because they're selling their house. They just may not want to let somebody that's a non-veteran assume that mortgage because that they didn't know they could be eligible for a higher amount than what they thought.
Okay, say they sell it to a cash buyer, they still have their benefit then.
Yes, their benefit would be reinstated. If that loan is paid off, their benefits are reinstated.
Okay.
If somebody assumes that loan that's a non-veteran,
right,
their benefits are not reinstated. Now, if I was a veteran going to assume another veteran's VA, my eligibility would replace theirs. They would be reinstated and they can move on.
Got it. Okay, thank you.
Yeah. So
They wouldn't, but that new veteran that's buying that veteran's house wouldn't be getting his low interest rate, right?
Yes, you could. They could still assume the loan, and they can use their eligibility to replace his eligibility and still assume that low rate.
Wow. Okay.
Now, did you know this? Did you know a non-veteran can assume an unlimited amount of VA loans? Here's what I mean. If I wanted to build a whole portfolio of investment properties, and I wanted the lowest rate I could possibly get, I would then only attack every VA assumable mortgage in the planet. And I could assume that mortgage. And because I'm not a veteran, I don't have any assumability to fill up. I can get as many of those as investment properties as I wanted. So if you have any investors that want a little hack on life, focus on just VA assumable mortgages across the country, and they can get as many as they want. As an investor, you can buy a home and assume a VA mortgage. You don't have to be a veteran. Guys, there's so many secrets in the mortgage industry nobody knows about. And my job is to try to make sure you're informed about what your buyers can do. Now, will I get any business from somebody assuming a mortgage? Zero. I don't make any money on it because they can't use me. They have to go with the mortgage company that holds the note. But I think it's important for you guys to know.
Hi, Sean, it's Cynthia. How are you? Mary Cynthia.
Hey, how are you today?
Thank you. Thank you for hosting this.
My pleasure.
It's interesting that you said that because during the summer of 23, I had an investor who was going to assume, and we were back and forth with the VA for 2 months. It took so long to go through the lender of the existing mortgage to get through to the VA. So there was only outbound by the VA lending part of the company, but not inbound. So we couldn't talk to them. And in the interim, they said to us, it was so weird, that he could not assume it. And he goes, why not? And he said, I used to do this in college, just as you said. That's how I paid for my college. I assumed all VAs as an investor.
Sure.
Because you're not using it as your primary residence. He goes, it doesn't need to be my primary residence. And what was really funny is he would never lie, but let's just say he lived in a smaller home because he lives in PV. He could have said, well, yeah, it's going to be, but it's obvious he's got this big, huge place versus why is he going to move all the way out there where this was? But he couldn't believe that they told him no. So what is up with that? It just happened.
Yeah, so here's what happened to that, and here's the reality behind it. The loan officers that are put in charge of doing the assumable mortgages for existing mortgage companies are not the ones that are really high performers. I would never in my life take on a role for our mortgage company as the assumable mortgage guy because I have my own book of business. There's no money in it for the company. That loan officer is not making anything. He's just getting an hourly wage. The way you do that is you fight with tooth and nail to get to the next person. Now, there are companies like I have a friend, Mike and Rochelle, that own a processing company for assumable mortgages. They are bulldogs. They will follow up with the right rules. They'll get to the right person and they will overcome those obstacles where they would say, no, we just keep fighting because they don't know the rules. They have no idea.
Interesting.
If you just say, I'm getting a VA loan to any loan officer that is trained through the normal channel, VA is only for primary homes. So if you look at normal guidelines for a VA purchase, they're right. You have to be, but they're not right because if you don't know the assumable mortgage rules, you're going to fail. And those people are put in a position to fail. So nothing against them. They're probably really good people. They just don't know the rules.
Well, how would my investor work with the person you're talking about that's a bulldog? They pay them some percentage?
Yes. So I believe, I don't know their exact fees right now, but last time I checked, it was 1% and it's paid for by the buyers.
Okay.
Right?
You're going to share his information or hers or
yes,
theirs.
I will do that in the follow-up email. I will do that in the follow-up email with all of their contact information. If you go to takemylowrate.com, that's them. Takemylowrate.com.
Yeah, their company's name is NUME, I believe.
What's it called?
NUME, N-U-M-E.
Yeah.
Yeah.
And so takemylowrate.com. Really great people.
Yeah, he spoke directly with him. It's Mary Cynthia again. And he basically sent the app just before he went on vacation, FedEx, and he was calling in direct. I was calling the other companies. So he never really literally then got through the correct division. Even though it was months, we thought that finally we were in the correct, and they wouldn't chat with me, the realtor. Even though I'm mortgage licensed too, they wouldn't chat with me on either end. and they wouldn't chat. They only would chat with him and the owner.
Yeah, that's where listen, we don't have the, do you guys remember the short sale days when there was short sale? All these different short sale processing companies started popping up. Every attorney in the world became a short sale attorney. They managed it for us so we could do our normal everyday business. That's what these Mike and Rochelle do. They will help, or Rachel, they will help you take that burden off and help, because it can take up to 60 days, but VA by law has 45 days to do this. So
Yes,
gonna
I
take-
know, right? And they
Yeah.
were over 60 and he kept saying that.
yeah, if you go longer than that, then you just need to, I mean, you could report them to the VA as and you can use that as a threat, which I know Rachel will totally do. But yeah, definitely something to look into.
Thank you.
Yeah, you're very welcome. So we went over a lot today. We went over the secondary benefits. I mean, we went over quite a bit. The new product that we have is a second home product. All of us know that there's these new loan level adjustments that happened January of 2022 that made second homes very expensive, basically the same as investment properties. We have a loan product now that eliminates about half the fees that are associated with those second homes. So right now they have a lot of points involved with them unless you put like 30% down. So it's a 3.5% cost on a 10% down mortgage just for having an additional points for it being a second home. So our product is basically cut that in half. So it's just a large savings to the borrowers. It's an in-house product that we have. And it's not as sexy as I thought it was going to be, because that's really the only advantage is, well, on a $500,000 home, that's a savings of about $7,500 in fees. So yeah, that's a big chunk. So if you have anyone with a second home that's looking to buy, we do have a really good product for that. But any other questions on what we went over today? Stacking buy downs. You guys have any questions on that? All right. Well, I thank you all for being on here as you do every week. And if you do need anything, I am always here to help. Weekends, evenings, I'm always available. My wife knows that too. I've been doing this for over 20 years. So she knows that if I'm busy, that means she can go buy a Jeep without asking me again. So something like that. So definitely give me a call if you need anything. And thank you guys so much and have a phenomenal week. I'll stay on here for a little bit longer if you guys have any further questions.
Thank you.
Absolutely. How do you find homes with a VA loan? Good
Thanks, Sean.
question. So there was a question, how do you find homes with a VA loan? You can actually search that. A lot of the listings have assumable in them already in their description. So you can search by just a keyword assumable. If you go to takemylowrate.com, they've done a lot of the legwork for you. They've got a website that kind of shows which ones do have VA loans. You can look it through Monsoon. You can find that through that way as well on the mortgage that they have on the properties. So there's quite a few ways to try to fine tune those and find those.
And title companies can get some that are not even on the market.
Exactly. So you can look for a list of homes that have VA loans and you can reach out to them direct. That could be a new farm strategy for you, but absolutely.
What was that percentage that second home buyers get? And where did they get that off? I missed that.
So the second home buyer.
Yeah.
So we have a new loan program that has about half of the fees associated with a second home. It's just a new
Okay.
loan program that we have internally. So
Okay.
yeah, instead of like right now, if you do a 10% down, there's 3.5 point cost that Fannie Mae added to that loan. You can, our program cuts that dramatically. So it's a fantastic new second home product that we have. So I'm going to be sending out in the email as well. So you guys can all have information on that.
Right, because I've got a couple of those.
Yeah, because it's
Right.
expensive. If
Yeah.
you're doing a 10% down on a second home, it's so expensive that lenders a lot of times can't even do the loan because it exceeds what we call a high cost mortgage. And it makes it so there's no way of doing it unless the sellers actually pay to bring those rates or pay the fees for them. So the buyer doesn't have to pay it. So yeah, it's pretty wild.
Cool.
Will
Thank
that
you.
affect the rate at all?
What's that?
Will that affect the rate at all?
No, the rates are still low. It's the same rate with just a lot less fees.
Thank you.
Is that what you meant by that?
Yes.
Yeah.
You know, I'm on the side of the real estate now. I really don't do mortgages, but I keep my license updated. So there's
That's good to
always,
know.
and today I was like, I have time to watch Sean, and I jumped on.
Well, I'm glad you did. It's been a while since we've connected. I'm glad that you jumped on. So thank you.
You're welcome.
Any other questions? All right, y'all have a phenomenal week, and then we will be in touch.
You too, Sean. Thank you. Bye bye.
Always do. Thanks so much.